I called the silver bounce at 72.6. Nobody believed it. While the crowd was panicking, while the headlines were screaming sell, while retail traders were cutting their positions, I was watching something else entirely. A floor, quietly being built. Comex was loading up. U.S. demand wasn't breaking. It was holding. And then silver bounced. Exactly. Where? I said. But here's what nobody is talking about right now. The same signal that called 72.6 is flashing again, and this time, the number isn't 75, it isn't 77. The target forming on my screen right now is something far more dangerous. Welcome to Currency Archive. Now, before we go any further, if you're watching this and you've been around long enough to know that markets don't lie, but the people explaining them do, then this channel was built for you. Hit that subscribe button. Think of it like setting up your morning newspaper. Except this one doesn't hide the real story on page 12. And I want to ask you something. Where in the world are you watching this from right now? Drop your city, your country in the comments below. Because the people watching this channel, they're not just from one place. They are everywhere. And they all have one thing in common. They want the truth, not the talking points. Now, let's get into what's really happening with silver. In the first week of February 2025, something quiet happened in the silver market. Not quiet in the way markets go silent before a recovery. Quiet in the way a room goes still when someone says something that everyone else is afraid to say out loud. Silver was sitting at 72.6. And while the headlines were filled with doubt, while analysts on financial television were debating whether silver had any reason to move higher, while retail traders were closing positions and walking away from the trade entirely, one signal was forming. Not a rumor, not a feeling, not a hope, a structure. The people who study markets at the institutional level, the ones who don't trade on emotion or breaking news, they were looking at something completely different from what the crowd was watching. They were watching a floor being built. At 72.6, silver wasn't simply resting between two price points on a chart. It was sitting at the convergence of multiple structural factors that historically, not occasionally, but historically, precede a significant price move to the upside. The February 6th candle had become what serious analysts call an anchor point. A moment in time where the market made a decision, where buyers showed up with enough conviction to absorb selling pressure and hold price within a defined range. That range was 72.6 to 70, and within that range, the data was building a case. Most people watching silver at that moment were asking the wrong question. They were asking, will silver go up? The right question, the one serious decision makers were asking, and was, why is this floor holding when everything around it suggests it shouldn't? That distinction matters enormously. Because when a price level holds under conditions designed to break it, when selling pressure arrives in volume and the floor does not crack, that is not luck. That is not coincidence. That is institutional defense of a position. And institutions do not defend positions without a reason. The U.S. demand picture at that moment was telling a story that the mainstream financial press was largely ignoring. Industrial consumption of silver across American manufacturing sectors, particularly in the energy transition space, in defense technology, and in semiconductor production, had not slowed down. It had accelerated. Silver is not gold. It does not sit in vaults waiting for sentiment to shift. Silver gets consumed. It gets used in solar panels, in electric vehicle components, in advanced weapon systems, in circuit boards that power the technology economy. When physical silver is being absorbed at the industrial level at an accelerating rate, and paper prices are being suppressed through derivative instruments on exchanges like Comex, a gap opens, and that gap does not stay open forever. The analysts who called 72.6 as the floor were not guessing. They were reading a convergence. The technical structure was aligned. The fundamental demand picture was aligned. The institutional positioning data was aligned. Three independent signals. One conclusion, the floor holds, the bounce follows, and yet almost nobody in the mainstream financial conversation was saying this clearly. Why? Because saying it clearly requires accepting an uncomfortable truth. That silver prices at that moment were not reflecting reality. They were reflecting managed perception, a manufactured narrative designed to keep retail investors uncertain, keep weak hands selling, and keep institutional accumulation running quietly beneath the surface. When silver bounced from that 72.6 support zone and began its move towards 75, then 75.5, the confirmation arrived not as a surprise to those who had been watching the structure. It arrived as a scheduled outcome. The call had been made, the logic had been documented, the levels had been defined, and the market followed the map. But here's what matters most for the business community watching this unfold. The bounce from 72.6 was not the story. The bounce was only the beginning of the story, because the same forces that built that floor at 72.6 are still active, still accumulating, still positioning. And the next chapter of this silver market The one that points toward $79 and potentially beyond is already being written. The question is whether you are reading it in time. There's a game being played in the silver market. It has been played for decades, and the majority of investors, including experienced ones, do not fully understand how it works, not because they lack intelligence, but because the system was deliberately designed to be misunderstood, to look like a fair market, to feel like a transparent exchange, to operate like a legitimate price discovery mechanism, while doing something else entirely beneath the surface. The Comex, the commodity exchange based in New York, is where the official price of silver is set every single trading day. Most people assume that price reflects supply and demand. It does not. Not entirely, not honestly, and certainly not in the way a business person making real capital allocation decisions would expect a market to function. Here's what actually happens. On the Comex, silver is traded primarily through futures contracts. These are paper agreements, promises to buy or sell silver at a future date. The critical detail that most casual observers miss is this. The overwhelming majority of these contracts are never settled in physical silver. They are opened, traded, closed, and the actual metal never moves. What moves is the price signal. And that price signal, manufactured through billions of dollars worth of paper contracts, travels out of the Comex and into every silver market on the planet. Physical dealers price their inventory against it. Miners negotiate contracts based on it. Investors make decisions because of it. An entire global market for a finite physical commodity anchored to a number produced largely by paper trading. That is not price discovery, that is price manufacture. Now here is where the trap enters the picture. In the weeks leading up to the silver rally at 72.6, something was building inside the Comex positioning data that institutional analysts were tracking with significant attention. Short positions. Specifically, concentrated short positions held by a small number of large financial entities. A short position in the futures market is essentially a bet that price will go down. The entity holding the short profits when silver falls. They lose, sometimes catastrophically, when silver rises. When short positions become heavily concentrated, when the ratio of paper shorts to available physical silver reaches extreme levels, the market enters what analysts call a technically vulnerable condition. The trap is set, not by one actor, not in a single moment, but structurally, through the accumulated weight of contracts that promised silver would fall, at precisely the moment when the physical market was saying the opposite. The physical market was not lying. Shanghai was trading silver at an $11 premium above Western spot prices. $11 on the same metal at the same moment in time. That premium does not appear randomly. It appears when physical demand in the East is absorbing real silver, bars, coins, deliverable metal, at a pace that paper pricing in the West has failed to account for. When the East is paying $11 more per ounce for physical silver than the Comex paper price suggests silver is worth. That is not a market inefficiency. That is a confession. A confession that the paper price and the physical reality have separated. That the managed narrative and the actual supply-demand equation are no longer pointing in the same direction. And historically, without exception, when that separation becomes wide enough, the paper market does not pull the physical market down to meet it. The physical market pulls the paper price up. This is precisely what the Comex trap looks like from the inside when it begins to close. The short sellers who built their positions expecting silver to remain suppressed suddenly find themselves exposed. Every dollar silver moves upward costs them. The higher the price climbs, the greater their losses accumulate. At a certain threshold, a level that varies but always arrives, they are forced to buy. Not because they want to, because the mechanics of their own position demand it. That forced buying, short covering, adds fuel to a price move that was already underway. It accelerates momentum. It pushes silver through resistance levels that would otherwise slow the advance. It transforms a bounce into a breakout. The business community needs to understand something fundamental about this moment in the silver market. The Comex trap that was quietly loading beneath the surface at 72.6 was not an accident of market timing. It was the predictable consequence of a system that had been suppressing physical reality with paper instruments for an extended period. Paper can delay price. It has never, in the entire history of commodity markets, permanently replaced it. The squeeze that followed the 72.6 floor was not the end of the story. It was the mechanism being tested, and the test results are pointing towards something significantly larger than what has already occurred. The next target, forming in the data, the $79 level that serious analysts are now watching, is not a number pulled from speculation. It is the mathematical consequence of a trap that is not yet fully closed. There is a difference between a price target and a price wish. Most of what circulates in financial media, on YouTube channels, on trading forums, and weekend newsletters, falls into the second category. A number attached to excitement, a figure wrapped in optimism, a target built on sentiment rather than structure. $79 is not that. $79 is the output of a calculation. A convergence point where multiple independent data streams, technical, macroeconomic, industrial, and institutional, arrive at the same destination through entirely different routes. When that happens in markets, it is not a coincidence worth dismissing. It is a signal worth understanding. Begin with the foundation. The U.S. support zone that held silver at 72.6 was not simply a line on a chart that traders decided to respect. Support zones of this nature, the ones that hold under genuine selling pressure, the ones that absorb institutional level volume without breaking, are built from something real. They are built from buyers who have done their homework. At 72.6, the buyers who stepped in were not retail traders chasing a bounce. The volume profile, the positioning data, and the subsequent price behavior all point toward entities that entered that zone with conviction and scale. Conviction means they had a reason. Scale means they had resources. And when entities with both conviction and resources defend a price level in the silver market, they are not defending it to sell at 74. They are defending it because their internal models built on data that does not appear in mainstream financial coverage, are telling them that the fair value of silver is significantly higher than where it was trading. That gap between where silver was priced and where institutional models say it belongs, that gap is the architecture of $79. Now bring in the macroeconomic layer. The Federal Reserve's position throughout this period has created a specific and measurable set of conditions for silver. Interest rate uncertainty, the ongoing debate between prolonged restriction and eventual easing, has kept the dollar in a state of structural tension. A dollar that cannot confidently move higher is a dollar that cannot confidently suppress silver. This matters more than most people realize. Silver's suppression over the past several years has relied heavily on dollar strength. When the dollar rises, commodities priced in dollars face mechanical headwinds. When dollar momentum stalls, when the Fed's path becomes uncertain and real yields begin to flatten, that mechanical headwind weakens. What was holding silver down begins to release its grip. The FOMC minutes released during this period confirmed exactly what institutional analysts had been anticipating. Not a dramatic pivot, not an emergency cut, but a softening of language that signaled the tightening cycle had reached its functional ceiling. For silver, that ceiling being reached is not a minor data point. It is a structural unlock. Layer 3 is where most analysts stop paying attention. And it is precisely where the $79 case becomes most compelling. Industrial silver demand in the United States and globally is not following the narrative that suppressed prices would suggest. It is accelerating. The solar energy sector alone consumed a record volume of silver in the most recent annual cycle. Not projected, not estimated, recorded and verified. Each solar panel manufactured requires a precise and non-negotiable quantity of silver. There is no substitute. There is no workaround. The laws of physics and electrical conductivity do not negotiate with commodity traders. Beyond solar, advanced defense systems, hypersonic technology components, next-generation semiconductor architecture, and electric vehicle power management systems are all consuming silver at rates that were not modeled into the pricing structure that produced 72.6. The market was pricing silver as though demand was stable. Demand was not stable. Demand was compounding. And supply, the other side of the equation that rarely receives adequate analytical attention, was quietly tightening at the same time. Global silver mine production has not kept pace with the demand acceleration. Primary silver mines, operations where silver is the main product rather than a byproduct of copper or zinc extraction, have faced rising operational costs, permitting delays and declining ore grades simultaneously. The pipeline of new supply that would be required to meet accelerating industrial consumption does not exist at scale. It will not exist at scale within any time frame relevant to the current price move. What this creates, when institutional defense of the 72.6 floor is combined with Federal Reserve policy reaching its ceiling, with industrial demand compounding beyond model assumptions, and with new supply structurally constrained, is not a trading opportunity. It is a supply-demand reality collision. And $79 is not where that collision ends. It is where serious analysts believe the first confirmation of that collision becomes undeniable to the broader market. The confirmation structure for $79 has specific requirements. Silver needs to maintain body closures above the 74.8 to 73.9 support band. Wicks below are acceptable. The market will test liquidity as it always does, but bodies closing below that range signal that the institutional defense is weakening and the timeline extends. Above current levels, the upside pathway runs through 77 first, a technically significant area where previous resistance will need to convert to support. If that conversion holds across multiple session closes, the path to 78.2 opens, and 78.2 is not $79. But it is close enough that the remaining distance becomes a question of momentum rather than structure. The structure is already built. The foundation was laid at 72.6. The floor was confirmed by institutional volume. The macroeconomic unlock was delivered by the Federal Reserve. The industrial demand reality is documented and verifiable. The supply constraint is not a projection. It is a present condition. What the business community needs to extract from this analysis is not a trading signal. It is a strategic awareness. Silver at $79 is not the end game of this story. It is the moment when the broader market, the institutional funds that have been waiting for confirmation, the family offices that have been watching from the sideline, the sovereign wealth positioning that moves slowly but moves with enormous scale, finally receives the evidence they require to act. And when that capital moves, the next chapter of this silver story will make the move from $72.6 to $79 look like the quiet beginning it actually was. History does not repeat in markets, but it rhymes. And right now, in the silver market, the rhyme is becoming loud enough that those who have studied previous cycles are not asking whether something significant is coming. They are asking whether they are adequately prepared for how significant it becomes. Because what follows a confirmed Comex squeeze, combined with a defended U.S. demand floor, combined with a Federal Reserve policy ceiling, combined with accelerating industrial consumption and structurally constrained supply, has a historical pattern. And that pattern does not end at $79. Go back to 2010 and 2011. Silver entered that cycle with a similar structural setup. Suppressed paper pricing disconnected from physical reality, concentrated short positions on Comex reaching extreme levels, industrial demand quietly accelerating beneath a mainstream narrative that was largely ignoring silver entirely. The institutional accumulation that preceded that move was not visible to retail investors in real time. It became visible only in retrospect, when silver moved from the mid-20s to nearly $50 in a period of months. The investors who understood the structure before the move captured the majority of the return. The investors who recognized the move after it became obvious captured a fraction, and many bought near the top. That pattern, early structural positioning followed by late retail recognition followed by exhaustion, is not unique to 2011. It is the anatomy of every major silver move in modern market history. And the early structural positioning phase of the current cycle is what is happening right now. The institutional accumulation patterns currently visible in the data are not subtle. Managed money positioning in silver futures has been shifting. The ratio of long to short exposure among the category of traders that includes hedge funds and sophisticated financial entities has been moving in one direction with increasing consistency. They are not selling into this structure. They are adding to it. Physical silver ETF holdings, which had experienced outflows during the suppression period, have begun showing inflow patterns that align with previous accumulation phases preceding significant price advances. Dealer inventory data from major U.S. precious metals distributors tells a parallel story. The availability of physical silver at spot-adjacent premiums has tightened. Lead times on larger orders have extended. The physical market is not behaving like a market with surplus supply and uncertain demand. It is behaving like a market where serious buyers have arrived. Now consider the timeline. The next 30 to 60 days represent what analysts who track these cycles describe as a critical decision window. Not because silver will necessarily reach $79 within that time frame. Markets move on their own schedule, and no honest analyst promises precise timing. But because within that window, the key confirmation levels will either hold or they will not. If silver maintains structural integrity above the 74.8 to 73.9 support band, if the advance through 77 converts resistance to support with conviction, if the east-west premium gap between Shanghai and Western markets remains elevated or widens further, then the case for $79 does not remain a case. It becomes a destination with a visible pathway. And when a destination becomes visible to the broader institutional community, the funds managing billions, the family offices protecting generational wealth, the sovereign entities diversifying away from dollar-denominated paper assets, the capital that enters is not measured in millions. It is measured in scale that moves markets. There's a deeper story running beneath the silver price discussion that the business community needs to understand with clarity. The global monetary architecture is under pressure. The United States dollar, which has served as the world's reserve currency and the anchor of global trade settlement since Bretton Woods, is facing a challenge that is no longer theoretical. BRICS nations have been systematically building alternative settlement mechanisms. Central banks globally, not in isolated cases, but as a documented institutional trend, have been accumulating physical gold at a pace not seen since the 1960s. Silver follows gold, not immediately, not perfectly, but structurally and historically. When gold moves in response to monetary system stress, silver follows with amplified momentum. Gold, at current levels, is not sending a subtle signal. It is sending a loud one. And silver, sitting at the base of a confirmed support structure with Comex shorts still exposed, with industrial demand compounding, with physical supply tightening, and with the monetary system entering a period of genuine architectural uncertainty, is positioned to receive that signal with force. What happens after $79 is not a single answer. It is a branching set of scenarios, each with different implications for the business community watching this unfold. Scenario 1. Silver confirms $79, converts it to support, and the broader institutional capital that has been waiting for evidence begins entering at scale. The move that follows targets the $85 to $90 range as the next structural objective. This is the scenario that the current data profile makes most probable, given the convergence of factors already documented. Scenario 2. Silver approaches $79, but faces significant paper resistance at that level. Concentrated selling through Comex futures designed to slow momentum and shake out weak positions before the advance continues. This does not change the destination. It extends the timeline and creates one final accumulation opportunity before the breakout becomes undeniable. Scenario 3. A macroeconomic shock, an unexpected Federal Reserve policy reversal, a significant dollar strengthening event, a broad risk-off liquidation, interrupts the structure before confirmation is achieved. In this scenario, the 72.6 floor becomes the critical reference point again. If that floor holds through the shock, the structure remains intact. If it breaks with conviction, the timeline resets entirely. Serious decision makers do not build strategy around a single scenario. They build awareness around all of them. They understand which signals confirm which pathway. They know what they are watching for. They have defined in advance what conditions change their assessment and what conditions strengthen it. That is not speculation. That is structured thinking applied to an uncertain environment. And that is precisely what the silver market is demanding from anyone who intends to navigate it intelligently over the months ahead. The call at 72.6 was not luck. It was the output of a disciplined analytical process applied to a market that was, and continues to be, sending clear signals to those willing to read them without the filter of mainstream narrative. The U.S. support zone held because the fundamental reality of silver demand made it hold. The Comex trap is closing because the laws of supply and demand, regardless of how long paper instruments delay their enforcement, always eventually prevail. The $79 target is not a prediction made in hope. It is a structured assessment made from evidence. And the business community, the entrepreneurs, the capital allocators, the strategic thinkers who understand that monetary history does not pause while the distracted argue about daily price movements. They are not waiting to see if the analysis is correct. They are already acting on the structure. The only question that remains is whether you are reading this early enough to matter.